Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Today, I thought we'd do something a little bit different. I thought we would answer some of the underwriting and loan product questions that we get from listeners to the podcast. I thought we'd do this type of a roundtable maybe once a quarter or so to give the most updated information in lending and kind of show what's working and what's not working. So the Old Capital Podcast is sponsored by Old Capital Lending in Dallas, and Old Capital closes on every 1 in 3 B and C apartment loans in Dallas and San Antonio and Austin. So we do hundreds of millions of dollars in loan closings. Today we have Hans Box, Ricardo, Hinojosa, and James Eng with Old Capital to give you some insights on how transactions are structured. We're going to share some stories and hopefully we'll share some challenges in lending. So loan structure is important, what LTV and what's an LTC, loan to cost, and what the heck that means. How much equity do I need and who are my sponsors going to be? Some of those are just typical questions that we get asked. The loan product is also important. So should we do a loan with a regional bank? Should we do it with Fannie Mae or Freddie Mac? And what's the difference between Fannie Mae and Freddie Mac? So working with an experienced group like Old Capital is critical in execution certainty. So listen to the professional background of our group today. So James Eng is a commercial real estate underwriter for the last 10 years. Before he joined Old Capital, our group, he was with GE Capital. Ricardo Hinojosa has been in commercial financing for almost 15 years. And what's great about Ricardo, he also took some action and bought an apartment building. So we'll listen to a little bit about his success on that too. So he knows how to underwrite apartment transactions. It's just not in theory, but in actual, his working knowledge about how things are put together. Our newest member is Hans Box, and Hans is a CPA and has a master's in accounting. He also owns a lot of commercial real estate. And so we're going to ask him about structuring different property types besides apartments. And then hopefully next quarter, we'll bring in another group of experts from Old Capital, some different guys from Old Capital to answer some additional questions. So guys, thanks for coming in. And Hans, how are you? Thanks for driving all the way up from Austin.
Doing well. Thanks for having me, Paul.
Good. And James comes all the way from Frisco, Texas.
Little city down the tollway here, but good to be here, Paul.
Good. James is right. His office is right across the street from the $5 billion mile.
Right. So Dallas Cowboys, Toyota, everybody's moving into sort of the North Dallas corridor that we like to call the Platinum Corridor. And so we're right in the middle of it.
That's great. And then Ricardo is from Dallas. And so say hello, Ricardo.
How's it going? Good to be here, Paul.
All right. I'm glad that you guys could all make it. So let's kind of start off with a question from a listener. And the first question that I thought was interesting is what's the difference with Fannie and Freddie and how do we qualify? And that comes from KR. So it says, thanks, KR. So Ricardo, I thought you'd take a stab at it if you could and kind of tell us a little bit about what the difference is with Fannie Mae and Freddie Mac and how do you qualify?
Yeah, definitely. So first, let's talk about qualification because qualification for the two are actually pretty similar. And then we'll get into some of the differences and how we kind of decide what direction we'll go in. So in terms of qualification, both Fannie and Freddie are looking for experienced principals. So no newbies. They want to make sure you've got experience with similar asset classes. So if you're looking to buy a 200, 300 unit apartment complex, the fact that you've got experience on a 5 or 10 unit may not, kind of fit the bill. So they want to see that you've got, relevant experience based on the asset that you're trying to acquire. And then they're going to look at, two of the key metrics, liquidity and net worth. From a liquidity standpoint, we're generally looking for at least 10% of the loan amount in post-closing liquidity. So that's after you've injected your equity into the deal in terms of a down payment. They want to make sure that you've got enough cushion, to kind of manage the ebbs and flows of everyday business. So at least 10% of the loan amount in post-closing liquidity. And then from a net worth standpoint, they're going to want to see that you've got amongst the guarantors of the borrowing group, they're going to want to see that you've got a net worth of at least the loan amount. So those are kind of, rules of thumb. Every deal is a little different, but that's kind of step number one in terms of how you qualify. In terms of how they differ, right? So the first thing that we do is we really like to get a feel for the specific asset or property and the objectives of the asset, right? So is it a value add deal where you're going to have rehab into the deal, or is it a clean asset from day one that requires no rehab? Because that is one of the key differences. Fannie Mae will actually allow you to roll rehab into the deal, approximately up to $5,000 per door, where Freddie Mac is not going to allow you to roll that in. So Freddie Mac, if there is rehab, you're going to have to, in general, bring that to the table yourself. On a plus for Freddie, they are a little more lenient from a prepayment penalty standpoint. So in general, with Fannie Mae, you're going to have yield maintenance that is a little more stringent. So if you're in a 10-year term, it's very difficult to get out of. Now you can add a supplementals with Fannie, but you're generally not going to want to pay it off within the first few years of the term. With Freddie, they're a little more lenient. They do allow a step down prepayment penalty with Freddie Mac. So those are really the two key differences. Another one is that Fannie Mae will allow you to add supplementals to the loan. So let's say 2 years in, you've added value, you've got a good amount of equity appreciation. Fannie Mae will allow you to, instead of refinancing, they'll allow you to add additional debt via a supplemental. Freddie Mac generally does not allow that. So those are some of the key differences that we see. And in terms of what direction you want to go in, again, it depends on the ownership group, what your goals are with that specific property, and kind of how we direct our clients.
A couple other things. You touched on what the borrower needs to qualify. One more thing to remember on Fannie and Freddie is the property needs to qualify. So it needs to be 90% occupied for the past 90 days in order to qualify for these types of loans. So not only you as the borrower needs to qualify, but the property needs to qualify. And one more, when we're looking at differences between Fannie and Freddie, Fannie has delegated underwriters. So these guys are lenders that have been approved by Fannie Mae that can improve the transaction without having to go back to Fannie Mae. So if it fits in the box, these lenders can approve it, whereas on the Freddie Mac side, all deals are going up to Freddie Mac regardless.
Freddie Mac is actually a newer program. It's called the Freddie Mac Small Balance Program, and it's been probably around for the last year and a half, 2 years. It's an interesting program because it's really trying to compete with the banks a little bit. So it's a 30-year amortization. And if you take a 10-year fixed rate loan, so 10-year fixed rate, you can also get a 20-year term. So you don't have a bullet like Fannie Mae has at the end of the, if you take a 10-year term, the loan has to be paid off at the end of the 10th year. If you take a 20-year or 15 or 12-year term, it's got to be paid off at the end of the 12th year. So with Freddie, you have the loan that gets fixed for, say, 10 years, and then it rolls over to an adjustable, so you don't have a bullet come in the back of your head that you have to refinance or sell that property in case something happens. So that's a pretty flexible program. James, quality of the structure itself, both pretty much the same. Would you think the property has to be in pretty good condition? Is it, are they looking for B and C properties? Are they looking for A properties? Tell me a little bit about the quality and condition of the asset itself.
Most of these Fannie and Freddie properties are going to have minimal deferred maintenance. So they're going to have an engineer go out to the property and take a look to see if there's any immediate repairs that need to be done on the property and make sure their rehab is a reasonable. In 6 to 12 months, can you really inject enough capital into this asset to stabilize it and keep it going? So they don't want to take, a 40, 50% occupied property or something with 10, 15, 20,000 a door to Fannie. So with that type of property, you really want to go to either a local or regional bank to execute, a bridge loan, and then once it's stabilized, take it over to Fannie or Freddie.
Yeah, Fannie Mae really is a stabilized lender. They're not a value-added lender. They're not putting Humpty Dumpty tremendously back together. I mean, just like what Ricardo was saying, that they will put some rehab dollars in. It's anywhere from $4,000, $5,000, $6,000, $7,000 will be allowed per door to put into the rehab, provided that the underwriting approves it for that amount. So you have a debt coverage ratio on that that's going to require you to have at least 125, 130 coverage in that. So the property has to be making money right from the start. So it's not something that it's a very distressed asset. It has to be a stabilized property that when we underwrite these deals, it's like us looking in a rear view mirror and how the property is done instead of looking in the front of the windshield to kind of figure out what it's going to do in the future. So we really rely upon the past to determine what the future is going to be on that transaction. Anything more to add on that, Ricardo, at all?
Yeah, I think that's covers it pretty nicely.
Yeah, so that's Fannie Mae, Freddie Mac example. And then question wasn't asked, but value-added properties. If a property is a distress asset, that's something needs Humpty Dumpty to be put back together. What's a solution on that one, James?
So we have a lot of relationships here in Texas with local and regional banks, and these guys allow you to come in at 75% loan to cost on transactions, 5-year, 25-year amortization, and really roll a lot of the rehab into the loan. And so on these transactions, we're looking at properties that have, north of 10,000 a unit in rehab that needs to be done, or the occupancy is extremely low. There might be a lot of down units. We're working with a client right now who 15 of the 80 units are down just because the current owner has run out of money. And so when they don't have capital, they start taking appliances and flooring from different units and pushing it into other units. And eventually that catches up to you. And so our buyer's coming in using a bridge loan to update all the units and get those, rent ready. And then once he has those set and stabilized and the occupancy comes back to market, 90, 95%, we'll be able to refi into a Fannie or Freddie product at that time.
Yeah, just to add on to what James is saying is that Old Capital has deep relationships with a lot of value-added lenders in the state of Texas and Oklahoma and some of the surrounding states and other states in the union. So we have these relationships that we've had intact for 20 or 25 years that know us very well, and we can kind of vouch for the transaction. What's interesting about Texas and where it is, let's say that there's 1,200 banks in the state of Texas, and let's divide it up by 400 or 500 are in Houston, 400 or 500 are in Dallas, and the difference are in San Antonio and Austin. And these are community banks. So out of the 400, let's say, are in Dallas, you're going to probably be challenged that if you went to Bank of America or Wells Fargo or Chase or something like that, that's not what they do. They're not a B and C value-added apartment lender. That's not just what they do. So it really comes down to a handful of lenders, and that number goes from 400 or 500 down to probably about 10 lenders that are going to actually do value-added properties that are going to give you the best terms. I mean, pretty much anybody can do. If you're working for a small community bank, maybe a 15-year amortization with a 5-year term with a rate at 6%, but that's not going to be good for you and for your cash flow and what you're looking to do. So by working with Old Capital as an example is that we have those deep relationships, and they come to us as business development people to make sure that they have enough money to lend out, because they do have requirements on how much money they have to lend out. And so they come to us to making sure that as a business partner with them, that we can provide them with enough business. So what I thought I would do is maybe go to next question number 2 that was asked, and I thought this was interesting too. What's the most difficult loan you guys have done recently? Why was it so difficult? Maybe someone's trying to figure out how difficult loans are. Thanks, from ML. And my point is that I've done this for 31 years, and is that you're really not a loan officer. I mean, you're a real good loan officer until you put a transaction together. You present it to underwriting, and then you wake up about 3 o'clock in the morning. And I'm talking about being wide awake and thinking, could I have structured that transaction differently? What did I need to do that was different? And we have a lot of things on our mind at 3 o'clock in the morning, making sure that we put these deals together. So, James, how about that question? Anything come to mind on one of the most difficult transactions that, let's say, you've done or group has done?
So we had a transaction in the first quarter of this year where we had done a bridge loan for the owner a couple years back, and now they had gone in, stabilized the property, but there was a couple quirks in the deal that made it a little bit more difficult. And so, it was in a rougher part of Dallas, and so there had been some crime issues on the property There had also been a master lease with one tenant. So
And how many units was this property?
north of 150 units. So
Good sized property.
good sized property, and the probably 15 to 20% of the units were leased to one tenant. And so we had a master lease, and then we also had crime issues on the property. And then a week before this deal was going to go to committee, there was a fire on the property, and there was already 8 to 10 units down because of a previous fire.
So this is like in baseball where you get 3 strikes and you're out. So you're on strike number 6 or 7 or 8, and you were able to get this transaction put together?
So what happened was it originally was declined by the lender, and we came back and talked through the issues that they had and came up with a new structure that really increased not only the lender's comfort, but then also got the borrower comfortable. So coming to a resolution and resubmitted the deal, we got engineers back out on the property to take a look at the new fire and got the deal closed. And so it was a non-recourse cash out refinance on a property with a murder, master tenancy, 2 fires, all within the last year.
Unbelievable. So you were able to pay off the loan that was currently on the property, that bridge loan that kind of put Humpty Dumpty back together again. And so by paying off the loan, you gave him millions of dollars in cash out.
Right. The existing loan was closer to $2 million, and then the new loan was over $4 million.
Wow. Yeah. That was a tough deal.
It was a tough deal, but I think some takeaways from that are, when you're underwriting the transaction, trying to present everything up front. So we see, 10, 15, 20 transactions a week, if not every couple days. And so we're able to identify the things that lenders want to see and understand up front, so that when we take your transaction in, we want to make sure that this is the right lender for the transaction. And so we can, as you send us, rent rolls and financials and borrower due diligence, we'll take a look at that, and we know what the hot buttons are for certain lenders. And so we're able to present that in the best light so that we can get your transaction through underwriting.
As we say, you can lie to your spouse, but do not lie to us, because we can kind of put the spin on it to make sure that it does make sense. But we just need to have the entire truth about what's going on in the transaction. So, Ricardo, any challenge stories that you can think of off the top of your head?
Yeah, so nothing as exciting as that one, but we've had a number of, every deal is unique. But just here recently, we ran into a specific deal where heavy value add, we had a local borrowing group that was coming in, purchasing a 60-unit asset in Irving, and they had a really solid game plan for the deal in terms of what they were going to do, come in, rehab, and really turn the financials around. So long term, they felt really good about the investment and what they had to do to get the property performing. The challenge was that day one, they weren't going to be, cash flowing on the deal to a significant extent. They weren't going to be hitting, the debt service coverage ratios that we usually want to see from a project. So we had to get a little bit creative. We didn't want to go in, and we wanted to find a happy medium where we could find them a good solution, solid terms, that could get them what they needed. So what we had to do was go in.
And that was turned down by another lender.
It was. It was initially turned down by a lender, not us. So we were kind of trying to put things back together in short order. So we took it to one of our local community bank lenders. We said, hey, we can work with it. We see the vision. We see kind of the long-term, positives of the deal. We had solid guarantors. What we had to do was put up a little bit of debt service up front. So it was about 3 months of debt service payments that they had to bring in with the deal to kind of set aside in escrow. But as soon as they hit a 1.2 debt service coverage ratio on the deal, and they sustained that for a few months, the bank would release that to them. So it was a little bit of a creative way to kind of get us where we wanted to be. Good terms, 25-year amortization, a year of interest only, solid interest rate. At the end of the day, met their objectives and also met the lender's objectives and we ended up in a good place. So we're able to get the deal done in a pretty quick period of time. We always have to be nimble, to try to figure out solutions. Every deal is a little different. There's always a challenge that comes up. It's just kind of knowing who to go to, who's the right lender for a specific deal in this market. And, we're pretty good at doing that.
Yeah, that's exactly correct, is that Ricardo had a challenge there because the borrower had brought the transaction to another lending source, and that lending source stumbled, and then we were called. So the cavalry came in at the end and saved the transaction. So we were heroes in that transaction. So nice little older property. It didn't, as Ricardo said, it didn't cash flow right from the beginning, and for the lender to feel comfortable that they put money into a CD, which was going to be released. So right on the front side of the transaction, instead of putting more money down that they couldn't get back unless they refinanced the property or sold the deal, 2 or 3 or 4 years from now, the bank was flexible. So that's one of the things that we can do. We work with the lenders, is that if it's not cash flowing right now and you have a discomfort, let's capture some additional collateral by having a CD for X amount of months. And then when you get to stabilized debt coverage ratio, and then you can release it back to the investors. And that worked out well for that group. Anything more to add on that one, or Ricardo or James?
No, I think it's just important to realize that when you're picking these lenders, you usually only get one chance to pick your lender. And so in a competitive environment like Dallas multifamily, the due diligence might be 30 days and you got 30 days to close. A standard lender is going to take about 30 days to underwrite the transaction. And so you can't try one guy and then go to the next guy. After a couple strikes, you're going to be out. And so the seller either is not going to negotiate anymore, or you're going to lose your money, your hard money, into the deal.
Tell everybody what we need up front just to review these transactions. We need a personal financial statement. Talk a little bit about what we need to underwrite these deals.
Sure. On the front end, really the trailing 12, if not the year-end financials, monthly is the starting point, along with the rent roll for a multifamily property, and then a personal financial statement along with a schedule of real estate. That will really answer the 3 questions we need to figure out what lender is the right source. So we need to figure out, 1, is the property stabilized? 2, how much net worth and liquidity you're bringing to the transaction? And then 3rd is what your level of experience in multifamily is. And once we're able to answer those 3 questions, then we can take it to the correct lending source the first time. That's
right. I agree. So here's another question. Does Old Capital only do apartment loans? And thanks, that's from DG. So Old Capital does about 80% of its lending in apartment transactions, but we also do office and retail and self-storage and new construction. Hans, can you walk me through a typical office transaction and what we are looking for? And can you touch a little bit upon self-storage? I know you like that type of property.
Sure, Paul. In office, it's very similar to multifamily in terms of that it's a multi-tenant property. It's a business just like multifamily is. And we're going to need the standard items that James himself just mentioned, which is historical profit and losses, pro formas, rent rolls, and guarantor info, such as a personal financial statement. And I wanted to touch on the personal financial statement because a lot of new borrowers that we service may not be clear on what that is. And that's actually a statement that shows your net worth and it shows your yearly income, which the lender is going to need to underwrite the deal, as James and Ricardo just mentioned. Basically, they'll need to look at your cash flow that you generate personally and the cash flow that the office building or retail center may generate as well on its own. And they'll look at that compared to the possible loan proceeds that they may be able to give you and come up with a debt service coverage ratio, which is a ratio that they use to determine the riskiness of the loan they're making. So many times in these deals, especially with first-time borrowers, it's very imperative that you have a strong personal financial statement in order to obtain a loan. At a high level, office is a little different than multifamily in that you don't have the advantage, I would say, of using a Fannie or Freddie type product, which typically would have a little lower rate due to the government subsidizing those loan types or guaranteeing those loan types. So instead, we have to look at going to more of your local bank, your regional bank, your credit unions, and even in some cases, I've seen the use of private capital in the self-storage industry. So, as Paul alluded to earlier, there's about 1,200 or more banks and credit unions across Texas, but not all of them like to lend on a $2 or $3 million office property in Euless, Texas, or in Tyler. So, the value that we bring is that we know who lends what and where, and then who to talk to at those lenders so we can push your deal through and get it done, especially for that first time, second time borrower that doesn't have a strong track record. But just like multifamily, it's experience matters, cash flow is important, but it's not imperative that you are a seasoned office operator, retail operator to get a loan. We're doing a loan right now for a group that all they had done was small multifamily, and we've already been pre-approved for a loan for them on a sizable office building. And this is their first go round with the office asset class, and it looks like it's going to go through quite well. And one other point I wanted to make is that on office, it's typically a recourse loan. Again, in multifamily, you can usually get non-recourse on most types unless it's a challenging type, and even then you can refi out into a non-recourse loan. But in office, recourse is usually the way you have to go.
James, any feedback on that?
I would say one thing that most multifamily guys take for granted is the leases are 12 months at a time typically on an apartment, and you have a very diversified source of income. It might be 100, 200 units. On these office buildings, you might only have 5 or 10 tenants. And so the value of the building really is the leases. So understanding the leases, what you have, who the tenants are, what the credit of those tenants are they going to maintain their occupancy? What other office buildings are they in? And then what the strength of their businesses are. So when I was an underwriter, that was the questions that I got when I was looking at 25, 30, $45 million office buildings. I mean, today in the news, in Houston, the office market is a very different place than it was 2 or 3 years ago, where a lot of these credit tenants are now giving back, hundreds of thousands of square feet that they signed up for. And so the market can change very quickly on the office side. And if your building has a heavy concentration of one tenant, that can dramatically impact your cash flows on that type of property. So office, you need to get a little bit higher return than, let's say, apartment, because you're taking on the necessary risk of more concentrated tenancy. And then also you're going to have more in reserves in terms of tenant improvement and leasing commissions for an office property. So they'll either build that into the loan or you need to reserve that. Similar to the way in an apartment you would have a capital reserve, you need to have not only a capital reserve for your main larger items such as HVAC and parking lots and roofs, but also a tenant improvement leasing commission reserve, so that when a tenant goes out, because they will go out, how are you going to re-tenant that space and repurpose it so that it's attractive for a new tenant?
And how about tenants that roll off the rent roll? Let's say that they only have 6 months remaining on the lease.
So a lot of these lenders will not include income from tenants that expire within 6 months, because unless you have a renewal in hand, they will exclude that income when they're underwriting their NOI. So you want to make sure that not only are there not any tenants that are expiring in the near term, next 6 to 9 months, but then also how is your rollover staggered? So look at the lease expirations and figure out, all right, in year 1, what percentage of my building is expiring, year 2 going forward, because no lender wants to see all of it in year 3 or 4. 95 or 100% of your building is rolling over in 1 year, because it'll be very difficult to lease all that space back in a short amount of time.
And then also talk a little bit about, Hans touched upon it, a regional bank is willing to put somebody new into the apartment business or office business or self-storage business. And those are usually transactions between, $500,000 up to about $5 million. Talk a little bit about CMBS loans for office and retail and things like that?
So CMBS is really a stabilized lender. They're going to really want the property to be stabilized. And not only that, really the minimums on CMBS are 3 to 4 million. Anything below that, it becomes very cost prohibitive. So whereas a local bank or regional bank might have legal cost of 5, 10,000, a CMBS transaction might have something, 50 to 75 up to 100,000 for a transaction. So on these smaller transactions, the CMBS execution doesn't make a lot of sense unless non-recourse is the only option for that borrower. So, but the larger transactions, as you really get above 5 million, it opens up the number of lenders who are willing to compete in the office, retail, industrial, self-storage space for those loans. So above 5 million really gets you into a whole new ballgame of lenders on the non-recourse side.
And Hans, you like self-storage because you own some self-storage. Tell us a little bit about why you got into the self-storage, and tell us a little bit about structure of some transactions that you closed.
Sure. Got into self-storage because I think as anybody's that's familiar with real estate, it's always heard that self-storage has great cash flow. So my business partner and I started exploring that option a few years ago when both of us have backgrounds in multifamily. So we're very familiar with the multi-tenanted property, very familiar with the leases that turn over, as James alluded to, every 6 to 12 months, depending on the property. And so it's very similar to multifamily, except that there's nobody living in the metal box. And that's the real...
We hope no one is.
Well, I mean, we haven't found any in our properties yet, but I've heard stories. The beauty of self-storage is that the leases do turn over on a monthly basis. Typically, it's not a lease. There is a lease, but it's a month by month. And that allows you to raise rents and kind of stay current with the market, step with the market as you need to in order to keep up. In fact, we probably raise rents on average for one tenant twice a year. And unlike multifamily, it's once a year. And our rents since we've bought the properties have averaged well over 8% a year in rent increases. And our operating partner, who's been operating since 2006, has never raised rents less than 6%. Now, that says something about the industry itself in that it's gotten a lot hotter over the last few years. Self-storage as an industry was about 75 to 80% mom and pop. And I think that's decreasing rapidly now as consolidation happens with the big REITs. And so that's really why we like self-storage, and the fact that we feel like it's probably 2, 3, 4 years behind multifamily in terms of maturity, in terms of getting noticed by the big REITs and the big institutional money. It's already out there, it's flooding the market, and it's getting harder and harder to find deals. But you can find the value add deal in self-storage right now, and we feel that really adds a level of safety for us, that we can buy a deal and put some value into it, whether that's deferred maintenance, improvements, expansion options, or professional management, that we can add value and lock in a gain day one, even if the market rents stay stable.
Yeah, you guys have, I don't know, tens of millions, but lots of millions of dollars of self-storage. Where's the market going? Is it a good market to get into?
Yes.
For a lot of people?
Yes, I think it really is, because it's easy to understand. People understand basically it's a place to store your stuff. It's good in the up times because people accumulate stuff. And it's good in the down times because people need to downsize their home but don't want to get rid of their stuff. So if you think about it this way, think of someone living in a 2-bedroom apartment and they're paying probably $1,200, $1,300 a month to live in a 2-bedroom. That's probably cheap, actually. And they want to downsize to a 1-bedroom because they can't afford to. Well, they may cut $600 off their rent to downsize to a 1-bedroom, but they'll only pay $100 to store all their stuff. So to them, they netted $500, and it's a really good deal for someone to go just store their stuff. So it's a great industry in that it's pretty stable in up and down times, and that's really why we like it.
And that's why we really like Hans, because not only is he a CPA, but he also is a lender for Old Capital, but he also has industry knowledge about what's going on in whether it's multifamily. He has a background in that, or self-storage, what he's doing right now, or office, what he works upon. So, tremendous amount of knowledge. I can tell you that 99 out of 100 lenders don't have the diverse background that the Old Capital crew does. So we know how to structure these deals because we own a lot of different types of real estate out there. Now I'm going to pick on Ricardo tell us a little bit about what you have, what you own.
Yeah, definitely. So I'm in the multifamily business as well. So again, like Paul mentioned, there's a lot of us on the team. They've got a ton of experience, and I've been fortunate enough to learn from a lot of the folks that are on this team. And as I've grown in the business over the last few years as an owner, currently own a little over 300 units. A business partner and I purchased an asset in a secondary market, Waco, Texas, earlier this year. Somewhat of a value add deal. It was stabilized asset. We did end up going Fannie Mae with the project because we feel that it's a longer term hold, but there was definitely some value add into the deal with some exterior upgrades, interior upgrades. We're putting in close to $5,000 a unit in total rehab, with the ability to drive rents. I mean, we've been in the project for a few months now and are already seeing $100 to $150 rent increases with some of the upgrades that we've done. So again, really happy with the project. And I think what that does is, again, it allows us to see both sides of the table and to really, provide additional value to our clients.
Give me a bit of a perspective about what CapEx you guys had put into the property.
In terms of the overall equity investment?
Exterior repairs.
Exterior
and
repairs.
Interiors.
Okay,
What's really driving those $150 rent bumps?
Yeah, so a couple of things. So one, the exterior common areas. So we really were able to go in. We did some pool remodeled the leasing office, repainted the exterior, new signage. We actually rebranded the property because it had a little bit of a negative history. What wasn't kind of the prettiest deal on the block, but now it is. And then on the interiors, went in, paint package, flooring, light fixtures, mosaic backsplash, new appliances, pretty much the works on the interior. So common areas, signage, rebranding, paint, and then the interior upgrades.
Is there anything when you were going, this was, your first Fannie Mae transaction and your business partner. So anything that you learned during that process that, you can maybe share with the listeners on when you're actually in the moment going through a deal like that? Any takeaways or that you would have done differently? The
nice thing is that I've done quite a few. We get to see a lot here. So I've gotten to see, tons of transactions. So I get to learn with every deal that we do. So from an underwriting standpoint, it was very, pretty seamless. No big surprises, good quality asset, high occupancy. So the transaction was pretty straightforward. I think from a rehab standpoint, one thing to watch out is that, Fannie does want you to knock out a lot of the rehab within the first 6 months. So that's one thing that VARs don't always think about, because you want to go in and upgrade all the interiors, but to do that in 6 months is pretty darn challenging, especially when you've got a property that's 95% occupied and you don't want to, take it down to 80. It takes time to turn the tenants and upgrade the unit. So you've got to, really have that buttoned up on the front end so that no time is lost and you can get in as much of the rehab as possible within that, 6 to 9 month window that Fannie allows.
Now, your CapEx that you put into the deal, did you have to do 125% and let the lender hold that?
Yeah, the immediate repairs. So what Fannie will do is they'll have an engineer come out to the property, assess it. So in addition to the rehab that you're doing, there may be some immediate repairs that the lender wants. For example, for us, it was about $100,000 of parking, which we were going to do anyway, but they were, hey, you've got to do this within the first 6 months. And yeah, they will hold back whatever that number is, plus 25%, and you get it back once you do the work. But those were, kind of what we were working with.
Anything more to add on that, James, at all?
No, I think and that's great. I mean, I think understanding having enough capital reserve when you're raising money for these transactions, because these loans, we might go in for 80 and it might be cut back to 75. The engineer might come up with some immediate repairs that you're having to hold back at close. And so raising the amount of capital and then also understanding your capital needs in the first 6 months when you're rehabbing these properties is very important.
So you can listen to the depth of knowledge of what the Old Capital crew has. We see hundreds of transactions a month, probably more than anybody else in our space of what we do. We are experts at what we do. A couple of things that I want to focus on right before we say goodbye to everybody here is that don't forget about the oldcapitalpodcast.com. So if you ever want to look and see what we're doing for transactions, take a look at the Old Capital Podcast to get more information. Another thing what I've always failed to tell everybody about is that we have a white paper. So it's called the Old Capital White Paper, and it's on financing for apartments. It's about 15, 16 pages. I think it's good stuff for somebody that just wants some basic information. You can listen to our podcast and we can kind of go over it. But if you want it in kind of one place, kind of what our takeaway about where the market is right now, what to set expectations correctly for new apartment buyers, take a look at the Old Capital White Paper on the financing apartments. And how you get that, you can send an email to info@oldcapitallending.com, info@oldcapitallending.com. And then don't forget that if you're in the Dallas area in June, I think it's June the 9th, and want to know what is going on in the multifamily real estate from the grand oracle herself, which is Amy Morgan with the CBRE Appraisal Group. And that's CBRE Appraisal Group, Amy Morgan. So they're national leaders on valuation, and she's going to give us some insight on how things are going in Dallas and Fort Worth and the rest of the state of Texas. She does an excellent job. She really gives us a little bit a better appreciation about how good and great Dallas is doing and where to buy the best properties out there, where to put more money into or start taking more money off the table. So, guys, how'd you think this roundtable went today?
I think it went well. I mean, definitely reach out to us if you have any transactions that you're going through or even considering. We can give you feedback on the transactions, within the day on where it would shake out. So before you obviously put in an LOI or go hard on any money, definitely reach out to us and we can give you feedback on your transaction.
Let me go around the table one more time. Hans Box, can you give us your cell phone number, direct conference to you?
Sure. Name is Hans Box, B-O-X, and number is 214-641-6309. And I work out of the Austin/San Antonio office for Old Capital Lending.
Okay. And James, what's your?
James Zhang. Phone number is 214-300-5035. And I'm here in Dallas, in the North Dallas area in Frisco.
Yep. Ricardo Hinojosa, and I'm in the North Dallas area as well. 940-597-7367.
Again, I'm Paul Peebles. We appreciate everybody's time. Thanks for coming into the Old Capital Podcast. Appreciate it.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview. Thank you for listening to the Old Capital